So, should we buy or sell the New Zealand dollar slash the US dollar currency pair? So, first off, read this disclaimer carefully. Then do your good deed of the day by liking and subscribing. It seems like the 52-week low data is not yet updated from Refinitiv. So yeah, the forex the pairs have fallen so much that it can't even be calculated. So yeah, we have seen huge falls in the forex market. The US dollar has strengthened. We've also seen the ruble strengthen. The thing is that the New Zealand dollar here, it has fallen down to a level that it in the past has found support. Yeah, the problem is that we have recently also lost a bunch of other support levels. But we do see, that the data is here. The bulls were able to stop the fall around where the lows of 2020 were formed on the weeklies. That doesn't mean it's going to go up. It means that we are at a level of interest for the bulls. If you look here at the RSI, on the weeklies, the previous time we had this approximate RSI level was here. That was a very temporary bounce within a downtrend. During 2020 and 20, we imploded lower. During 2018, let's find 2018. Yeah, during this sell-off here, we did see some bounces before we formed the key low. Distance here from the 50-week moving average and blue 100-week moving average is at the levels that formed the major lows in the past, back here in 2020. That doesn't mean it will happen again. It just means that there is precedence for major lows at these levels. Looking at the daily data point, we see something very similar here. On the RSI, on the 20-day, 50-day, and also the 100-day moving average PPOs. The previous time we had similar readings. We have formed either some temporary bounces like here and there, or even more major lows. So in this case, we are at RSI and PPO support. I think I will give the bulls, I think I give them a 5. This is an interesting opportunity. The issue is that, there's been a lot of times where these readings have only triggered a temporary bounce in a primary downtrend. Here is the seasonality. The issue for New Zealand is that, well, the New Zealand dollar is that there usually is some mediocre seasonality until the 3rd of October, and then we do have strength into late October. So potentially a bit more weakness, but then seasonal strength comes, at least temporary strength. Over the last 5 years, from September to November, December, the seasonality improves very substantially. Over the last 10 years, so from September to October usually gets weaker, but then November and especially December is very strong. And then the last 20 years, it gets messy because October is a decent month, but then November is weak, then December is the strongest month. So I give the bulls a 1 here. The timing is not that good, but it's not bad either. It's just that there might be a bit more weakness before some temporary seasonal strength comes around the corner. Then we usually see more weakness, and then there's a super strength into December. So overall, just messy. On the fundamentals, I give a -2 here to the bears, and that is, due to New Zealand's location. There is some intensification of the conflict between America and China. That might get worse. Hence, New Zealand is in a very tricky place geopolitically. When you are, an island country, and there's geopolitical conflict, there can be some major issue when it comes to trade. So I think I lean a bit bearish due to just the messy situation. Here you can see the trading partners. Well, the primary export partner here for New Zealand, China at 28%. Import partner, China at 18%. So the odds of America telling New Zealand to be a part of some trade sanctions, boycotts, very very high, I think. Okay, so here is relative performance. So long term, we have 59% for the S&P 500, 90% with the New Zealand stock market ETF, minus 21% with the US 10-year yield, minus 81% negative, with the dollar index. Short term, daily data points, that is 84% with S&P 500, 91% with the New Zealand ETF, then minus 79% all of a sudden with the 10-year yield. It's in the very low end of that range, however. Then minus 94% with the dollar index. What happened? The New Zealand ETF, stock market ETF, is very likely going to affect the New Zealand dollar. Yeah, so here is the chart of the ETF. We had this low here from mid-June that could have helped the bulls. But when you look at, this week, we closed below it, so it's not that good. You also had potential horizontal support from back here in 2018, but we are closing below it. So there might be some support back here from these highs of 2014, but the situation for the ETF is not bullish. On the daily data points, you could make the case that at least the bulls, they might turn this and this into a double bottom. It's one of the opportunities they have, one of the few opportunities they have, because they have lost, so much. Messy situation here on the RSI and the PPOs. On the daily data points, the same thing, because we are not really yet at support levels on the PPO and RSI. So basically, bulls that look at RSI and PPO to enter bullish positions, they are not going to look at this and be like, this is a time to buy. They are going to look at this and see, well, if it goes lower, then I might buy. Here is the relationship between the currency pair and the ETF. In this case, this looks like a very substantial rounding bottom. That is bullish. This is, however, a more mature rounding bottom. This is not like early anymore, but long term, this is definitively a rounding bottom, suggesting that longer term, the currency itself could very much outperform the ETF. So cash might be a bit of a king. Looking at the seasonality, we do see that the currency usually outperforms being in the ETF, leading into early October. In this case, we end up with a 0.8 in favor of the bulls. So noisy data. We are at RSI and PPO support on the New Zealand dollar US dollar pair. That is the main event at the moment. It's an interesting opportunity, but the problem is that there's a lot of noise here. But there's slightly more reasons to be bullish than bearish. So we have some time left. Let's look at some of the stocks inside the New Zealand stock market ETF, ENZL. First on the list at 13.20% of the ETF is Fisher and Paykel Healthcare. In this case, it's, there's a change. So let me just draw it in. This is obviously bearish. Well, that was a bit too much. This is obviously bearish. Not so obviously bearish. It's not bullish either, but there's a change. Instead of going down, we are forming some kind of a low. Going to the daily data points, There is some lowish behavior, but not bullish either. It's like there's a change, but going from like very bearish to sideways, um, it's the sideways move could extend for quite some time. But at least the bears are not like totally dominating at this point, so there's that. But I think that if you get in at the low of the range, which you could now, at least you do know where to put in your stop levels. But I mean, you have to do more research, but there's something here with this ETF. I certainly prefer investments where I can have a very clear stop loss. Here is a Spark New Zealand. Yeah, this chart is looking good. It's been in a uptrend ever since 2011. But this is also one of those situations where you look down here and you're like, well, I did miss a 333% move. There's that. So yes, we do have a breakout now above the highs of 2015. No, 2005. 2005. Okay, 2005. So you have a potential breakout, but you also have missed, a 300+% move. So there's that. But yeah, at least this chart is looking decent. But you see here that it is very much an erratic chart. So let's say that if you buy here, 6% gain, 7% loss, 9% gain, 7% loss. So it's one of those where you really do want to get in at a recent low if you are a bull, or short a recent high. It's just very much it moves in these very short time cycles. Here is Auckland International Airport. So the thing is that airports, they do have a lot of moat, because it's a very difficult process to start and make and operate an airport. The issue is that in the time of potential major trade wars, this is also a very risky business as well. So yes, there is moats. The risk of competitors is not really that high, but the risk of other things is very high. So you also have a head and the shoulders. This is a huge multi-decade head and shoulders. So that's bearish. Going to the daily, you can see here that the red 200-day moving average is very aggressive as a resistance level. Next on the list is Meridian Energy. Certainly sounds like an energy company. It could be utilities as well, though, but yeah. Here is the red 200-week moving average, showing its importance. Very good as a level to put in your shorts, but it can also be good for longs. The problem is that the most recent change in the relationship between price and this moving average is that it is now a very clear and I think basically surgical resistance level. So the bears are using it to short. It is interesting that the bulls are allowed to test it. It increases the probability of a breakout. But the bulls can only try to break out that many times until the bears can call their bluff. So yeah, it's the bulls, they need to hurry up, because if they don't, then the bears will just put on massive short positions, because the bears can just put on huge short positions knowing exactly where to put in their stops. So there's that. That's also the danger of testing any kind of resistance level without breaking through, because it becomes so easy to put on shorts. And if the bearish pressure, the selling pressure through the shorts and puts reaches a critical level, then the gravitational pull is just going to be too strong for the bulls to break through, and then the bears are really going to increase their positions. And yeah, and that is just something to be aware of when it comes to investing, is that there's a lot of self-reinforcing feedback loops that are very important, because the market is dynamic. So a bullish level can work really well when it gains legitimacy. But if you do, as an example, have like a bullish level, and then the bulls are not able to really push on, to make higher highs and higher lows, then the bears will just call that bluff. And if the bears start calling the bluff, then the bulls will tighten their stops, and then the bulls will add selling pressure, and then it becomes a mess. So yeah, the market is very dynamic. That is extremely important to just be aware of. So you could have like an investment thesis that has all the bullish things, amazing fundamentals, technical seasonality, but if there's not enough fence sitters jumping down into the bullish theme, then the bears will be able to win.